Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sigma Lithium Corp.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do it.
We are really dissecting a fascinating story here of a miner that is just executing exceptionally well.
Almost counter-cyclically, right?
Exactly. In a lithium market that has frankly been pretty punishing over the last year, the core theme here is financial robustness, and it's all driven by operational efficiency.
The numbers really were stunning when we looked at them. They tell a very specific story about acceleration.
It's not just incremental growth.
No. Looking at their Q3 2025 revenue, they posted a massive 69% sequential increase over the previous quarter.
Yeah, that's not just stable year-over-year stuff. That's exponential ramping as their production hits full throttle.
And what's so critical here is that the revenue surge isn't just about, selling more volume.
No, it's about selling smarter.
Yeah.
And cheaper. The real insight, I think, is in their margins.
Definitely.
We saw gross margins expand significantly in Q1 2025, hitting an impressive 58.1%.
Help me with that number for a second, because for listeners who aren't deep in the mining sector, a nearly 60% gross margin sounds almost unbelievable.
It is.
Especially with commodity price volatility. How does that compare for them, say, historically?
It's a profound change. That 58.1% figure is almost double the margin they reported just 1 year prior.
Wow.
That doubling, that's the key takeaway. It's more important than any single revenue number, really. It signals superior cost control that's structural, not just, a one-off.
Right. It suggests they fundamentally cracked the code on this.
And they're managing to maintain that discipline in their day-to-day operations, too. The analysis shows this phenomenal resilience, with their cash operating margin holding steady in that 41 to 42% range.
Maximizing revenue while minimizing any leakage.
Exactly. And this all leads to what is perhaps the most unique piece of this analysis, their balance sheet health.
In a sector known for heavy debt and constant capital raises.
Especially in the junior mining space, this company stands out as a genuine unicorn.
You're talking about their net cash positive position.
I am. It's almost unheard of for a growing miner.
It really is.
As of Q1 2025, they had $94.2 million more cash than their total debt. Just think about the strategic flexibility that gives them.
Yeah, they're not dependent on whatever the market is doing to make their next move. They can self-fund.
And that ability is backed by consistent free cash flow, FCF.
Right.
They've generated a positive FCF for 5 straight quarters, hitting $24.7 million in Q1 2025 alone.
So when a company can generate that much cash internally, it means they can fund their expansions without constantly going back to the market and diluting shareholders.
And that connects back to the bigger picture. Their Brazilian projects are proving to be exceptionally capital efficient. They're creating this self-sustaining loop.
Low costs, high margins.
Which generates massive cash flow, which in turn funds the next expansion. It's a huge competitive edge.
Okay, so that financial strength, it seems to flow directly from their operational moat. Let's shift to what they actually do, what they dig out of the ground.
That's where the long-term value really is. They're positioning themselves as a leading pure-play lithium producer.
And the target is big.
A substantial 270,000 tons in 2025. And what's important here is that they've already executed the Phase 1B expansion.
Right, so they've proven they can build and scale.
Push their total capacity up to 450,000 tons of spodumene concentrate. It's a big deal.
But the real premium isn't just volume, it's the quality, right? The sustainability. They call their lithium 000.
Yes.
What does that actually mean, and why does an automaker in Europe care?
000 means near zero carbon, zero tailings, so minimal environmental waste, and zero hazardous chemicals. And this is not just fluffy marketing.
It's quantifiable.
It is. It's quantifiable data that creates a massive pricing advantage in today's market.
So how do they do it? What makes their Brazil operation different from, say, a typical hard rock mine?
It's mostly energy and water. They integrate solar power directly into their operations, and crucially, they avoid those water-intensive evaporation ponds you see a lot in South America.
Which are often a huge regulatory and environmental headache.
A massive one. This method lets them operate with about 17% lower CO2 emissions per ton compared to a lot of their peers.
So for a big EV maker trying to meet strict ESG mandates in Europe, or maybe capitalize on the Inflation Reduction Act in the US, This is the lithium they want.
This is the supply they want, and that green premium is
Well,
translating directly to their bottom line.
absolutely. The sustainability piece is directly tied to their low costs.
Remember that Q1 2025 unit mining cost, $3,120 per ton. That is demonstrably among the lowest operating costs globally for spodumene.
So you combine the lowest input costs with a premium product that gets a higher price.
And you get that 58% gross margin we were talking about. It all clicks together.
And this is where the stability comes in. They haven't just relied on spot prices.
No, they've been smart. They've locked in long-term contracts. That's a huge part of the risk mitigation here.
And these are high-quality binding contracts.
They have an offtake agreement with a subsidiary of a Tier 1 EV battery maker, we know it as MHI, for 10,000 tons a year, all the way through 2030.
That's incredible visibility.
It is. And the pricing on that is the real kicker. They secured a premium price of $16,200 per ton.
Plus an escalator clause.
Yep, pegged to CPI plus 2%. That is a phenomenal protection against long-term inflation.
So when you look at their whole sales picture, it shows how well insulated they are.
Totally. A massive 90% of their projected 2025 production is already contracted at or above that $16,200 level. They are, for the most part, completely shielded from the day-to-day spot market anxiety.
Which is so rare in commodities.
It really is.
Okay, so that financial and operational picture sounds like a home run, but every investment has risks. We have to talk about the elephant in the room that analysts always point to.
The concentration risk?
Exactly.
It is the critical vulnerability, and it's quantified starkly in their Q1 2025 results. 94% of their revenue came from that one large customer, MHI.
So if that contract were ever jeopardized,
It would create a severe and immediate financial shock. No question.
and that level of dependency is generally what makes investors nervous, especially when you look at their valuation. They trade quite a bit cheaper than their peers.
Absolutely. And this is where we connect the dots between risk and valuation. The company trades at an EV to EBITDA, multiple of, what, 7.8 times?
And the sector median.
The median for their peers is around 11.4 times. The market is clearly not giving them full credit for that 58% margin or the net cash position,
Why?
because it's pricing in that single major risk factor, concentration. The low multiple is the market saying, great numbers, but that one customer makes us nervous.
So what's management doing to mitigate that beyond the penalties in the contract?
Well, the penalties are strong, so non-performance is costly for the buyer. But the real active mitigation is diversification. Management has confirmed they're in negotiations with 3 new separate potential European buyers.
Okay, so these are serious talks.
Very serious.
Yeah.
And securing even one of those new offtake deals would immediately and drastically reduce that 94% figure.
Which could lead to an almost instant re-rating of the stock.
You'd think so. Closer to that sector median, at least.
And we can't ignore the general bear case either, right? The global slowdown in some EV markets, the impact on spodumene prices.
That's fair. But again, the spot price volatility is made less critical because of those long-term contracts.
The margins act as a buffer.
A massive buffer. They can weather a sustained commodity dip far better than a competitor who's just selling on the spot market. Their costs are just too low, and their contracts are too rich.
Okay, let's turn to the future. For someone monitoring this stock, what are the near-term catalysts, the events that could really move the needle in the next few months?
There are a few, and you can sort of put them in 2 buckets, institutional flow and strategic expansion.
Let's start with institutional flow.
Okay, so we have some predictable triggers. We expect inclusion in a major ETF rebalance, probably in late November 2025.
And for the listener, just remind us why an ETF rebalance matters. It can sound a bit academic.
It's anything but. When a stock gets included in a major ETF, that fund is forced to buy millions of dollars worth of shares, regardless of the price.
So it generates this mandatory institutional demand.
Exactly. It boosts volume, often creates upward pressure, and right after that, we have the required institutional 13F and 13G disclosures due around December 20th.
And those will show us which big hedge funds and institutions have been buying in.
Precisely. If we see major reputable names showing up with large positions in December, it validates the long-term thesis and often prompts others to follow suit.
And beyond the mechanics of the market, there's the company's own calendar.
Right. The Q4 earnings report in mid-January 2026, and then the full-year update in February.
And what will investors be looking for there?
One thing above all else, margin sustainability. They want to see that 58% gross margin hold up, confirming that the cost advantages are a stable reality, not a one-off.
Now for the most quantifiable catalyst, Phase 2 expansion.
This is where the sheer volume upside is. Phase 2 is slated for commissioning in Q4 2025.
A clear, verifiable increase in production capacity.
And once that's operational, it feeds directly into higher earnings estimates for 2026, giving analysts a concrete reason to raise their price targets.
What's also fascinating is the potential for a regulatory tailwind here.
Yes, the non-dilutive capital. Given their sustainability profile, they seem perfectly positioned.
You mean things like the EU Critical Raw Materials Act?
Exactly.
Yeah.
Because of their 000 process, they're uniquely competitive. Gaining approval could yield a significant non-dilutive grant, maybe between $15 and $25 million.
So funding that goes straight to their balance sheet without issuing a single new share.
It's a huge incentive for scaling up sustainably.
And finally, you have the speculation that just never seems to go away.
The M&A rumors.
Yeah.
The chatter has been persistent, and it makes fundamental sense. Global battery and mining giants are always looking to secure long-term, low-cost, and especially low-carbon lithium supply.
We've seen names like Albemarle thrown around, whispers about a big U.S. EV maker.
And if an official M&A interest were to materialize, especially at this suppressed valuation of 7.8 times EV/EBITDA, it would obviously be a game-changer for shareholders.
The technicals seem to support the bullish view, too.
They do. The stock has been trading consistently above its key moving averages, the 50-day and 200-day, confirming that upward trend.
And we also noted that technical breakout back in March from that multi-month ascending triangle, that's usually a sign that institutions were already accumulating shares.
So synthesizing all of this, the narrative is pretty clear. This company has managed to blend, the best of operational execution with real environmental foresight. They've secured premium pricing for their green product, and it's all backed by one of the lowest cost structures in the industry.
And that combination, low-cost, high-priced contracts, it gives them a clear path for upside and insulates them from the sector's famous volatility. You should continue to watch their operational updates, especially the Phase 2 ramp-up and I think the December institutional flow disclosures.
And a final thought for you to consider. As global economies keep mandating lower carbon supply chains, especially for EVs, the premium placed on verifiable green lithium is only going to increase. This company isn't just surviving the downturn, it's positioning itself to thrive as a necessary, high-quality supplier in the clean energy transition.
Thanks for tuning in to Smart Wealth with Joshua, and be sure to subscribe for more analysis.